Most people think investing begins the moment you buy your first stock. It doesn't. Investing actually begins much earlier, usually in that uncomfortable moment when you realize that simply working for money is never going to be enough. You can keep earning, keep saving, keep trying to be responsible, and still feel like you're barely moving forward. Your paycheck comes in, your bills go out, and whatever is left sits in your bank account doing almost nothing. On the surface, it feels safe. But underneath, something else is happening. Inflation is quietly eating away at your purchasing power. Time is passing whether you use it or not, and the gap between people who invest and people who don't keeps getting wider. That's why learning how to invest matters so much, especially if you're a beginner. Not because investing is some exciting shortcut to becoming rich overnight, and not because buying a few stocks will suddenly transform your life by next month, but because investing is the point where your money stops being completely dependent on your labor. It is the moment you begin building a system that can grow with you, support you, and eventually do part of the heavy lifting on its own. The problem is that most beginners never get that far. Not because they're lazy or incapable, but because the entire world of investing looks far more complicated than it actually is. The language sounds intimidating. People throw around terms like ETFs, index funds, asset allocation, diversification, brokerage accounts, Roth IRAs, tax advantages, market volatility, and compound returns as if everyone should already know what they mean. So the average person does what most people do when something feels confusing and high stakes. They delay. They say they'll learn later. They wait until they have more money, more confidence, more certainty, or more time. And while they wait, they miss the one advantage that matters most in investing, which is time itself. Most people think investing begins the moment you buy your first stock. It doesn't. Investing actually begins much earlier, usually in that uncomfortable moment when you realize that simply working for money is never going to be enough. You can keep earning, keep saving, keep trying to be responsible, and still feel like you're barely moving forward. Your paycheck comes in, your bills go out, and whatever is left sits in your bank account doing almost nothing. On the surface, it feels safe. But underneath, something else is happening. Inflation is quietly eating away at your purchasing power. Time is passing whether you use it or not, and the gap between people who invest and people who don't keeps getting wider. That's why learning how to invest matters so much, especially if you're a beginner. Not because investing is some exciting shortcut to becoming rich overnight, and not because buying a few stocks will suddenly transform your life by next month, but because investing is the point where your money stops being completely dependent on your labor. It is the moment you begin building a system that can grow with you, support you, and eventually do part of the heavy lifting on its own. The problem is that most beginners never get that far. Not because they're lazy or incapable, but because the entire world of investing looks far more complicated than it actually is. The language sounds intimidating. People throw around terms like ETFs, index funds, asset allocation, diversification, brokerage accounts, Roth IRAs, tax advantages, market volatility, and compound returns as if everyone should already know what they mean. So the average person does what most people do when something feels confusing and high stakes. They delay. They say they'll learn later. They wait until they have more money, more confidence, more certainty, or more time. And while they wait, they miss the one advantage that matters most in investing, which is time itself. This is why a beginner-friendly approach starts with a cash cushion. You want enough money set aside that normal life problems do not force you to raid your investments. Your car needs repairs, your laptop dies, your job situation changes, your rent goes up, or some medical bill shows up out of nowhere. These things are not unusual. They are part of life. And if every one of them knocks you off course, your investing journey will feel chaotic from start. A basic emergency fund gives you breathing room. It separates your short-term safety from your long-term growth. That one separation changes everything. Once you have that cushion in place, the next step is understanding what investing actually is. At the most basic level, investing means putting your money into assets that have the potential to grow over time. Instead of your money sitting still, you give a job. You put into businesses, funds, or other assets that can increase in value or generate income. The key phrase here is over time. That's where most beginners get tripped up. They hear stories about people doubling their money quickly, making huge bets, or catching some hot stock at the perfect moment, and they assume investing is about speed. It isn't. Real investing is not about trying to look smart this month. It is about building wealth over years and decades. That difference matters because if you approach investing like entertainment, you will almost always make emotional decisions. You'll chase what's hot, panic when prices fall, and confuse movement with progress. But if you approach it like a long-term system, your behavior changes. You stop asking, what will make me money fast, and start asking, what is the most reliable way to grow my money over a long period of time? That is the question beginners should be asking from day one. And the answer, for most people, is surprisingly boring. Not individual stocks, not trying to outsmart the market, not betting on the next big thing. For most beginners, the smartest place to start is with low-cost index funds, or ETFs. These are simply investments that let you buy a large basket of companies all at once. Instead of betting everything on one company doing well, you spread your money across many businesses. That reduces risk, keeps things simple, and gives you exposure to the overall growth of the market. This is one of the biggest mindset shifts a beginner needs to make. You do not need to be brilliant to become a successful investor. You do not need to predict the future, read balance sheets all night, or spend your weekends hunting for hidden gems. In fact, trying too hard is often what gets people into trouble. Successful investing for beginners is usually less about doing more and more about avoiding the mistakes that ruin returns. High fees, emotional decisions, constant buying and selling, trying to time the market, and overconfidence destroy far more wealth than a lack of intelligence ever does. Think about how most people imagine investing. They picture someone glued to financial news, reacting to charts, making split-second decisions, constantly tweaking their portfolio. It looks active. It looks impressive. It also looks exhausting. And for the average beginner, it is unnecessary. The truth is that a simple strategy done consistently beats a complicated strategy that you can't stick with. That's one of the most important ideas in all of personal finance. Complexity sounds sophisticated, but consistency is what actually builds wealth. So before you ever invest your first dollar, you need to settle this in your mind. You're not trying to win a short-term game. You're building a long-term machine. And long-term machines work best when they're simple, durable, and hard to break. That is exactly why step-by-step investing works so well for beginners. It removes the noise, lowers the emotional pressure, and gives you a process you can repeat whether the market is up, down, or going nowhere. The next step is choosing where your investments will live, because you don't just invest in the abstract. You need an account. For most beginners, this usually means one of two paths: a retirement account with tax advantages or a regular brokerage account. And this is where investing starts to feel more real, because now you're moving from theory into action. You're no longer just saying, I should probably invest someday. You're creating the actual container that will hold your future wealth. A retirement account is often the best place to start if it's available to you, especially if your employer offers a match. If your job gives you a 401k match, that should get your attention immediately, because that is one of the closest things to free money you will ever see. If they match a portion of what you contribute, your money is growing before it even has time to compound. That is an instant return, and ignoring it usually means leaving part of your compensation on the table without realizing it. If you don't have access to a workplace retirement plan, or even if you do, you may also have the option of opening an IRA. And this is where many beginners freeze up because the choices start sounding technical again. Traditional or Roth, pre-tax or post-tax, deduction now or tax-free growth later. But the important thing to understand is that these are just different tax wrappers around your investments. The actual investing can still be simple. The wrapper matters, but it should not intimidate you into doing nothing. For many beginners, especially younger people or those who expect their income to rise over time, a Roth-style account is often appealing because you pay taxes now and then your investments can grow tax-free going forward. That could be incredibly powerful over decades. But the broader lesson is more important than the account type itself. The lesson is this: where you invest matters almost as much as what you invest in, because taxes can quietly drag down your growth if you ignore them. A smart beginner doesn't just ask how to invest. They ask where to invest first. Once your account is open, the process becomes far less intimidating than most people expect. You link your bank account, transfer money in, and choose your investments. That's it. Not easy emotionally, perhaps, but mechanically it's not complicated. And that realization alone is powerful because it breaks the illusion that investing is reserved for experts. It isn't. It is a system ordinary people can use as long as they stop waiting for the perfect moment. Now, this is the point where a lot of beginners make their first serious mistake. They open the account, move some money over, and then freeze. The money just sits there in cash because they assume opening the account means they already invested. It doesn't. This happens more often than people realize. Someone sets up a retirement account, feels productive, and then unknowingly leaves their money uninvested for months or even years. Technically, they did step one, but they never actually gave the money a job. So if you remember one practical lesson from this video, let it be this: funding the account is not the same as investing the money. Once the money arrives, you still need to choose what to buy. And this is where simplicity matters most. If you're a beginner, your first investment does not need to be clever. It needs to be diversified, low cost, and easy to stick with. That is why broad market index funds are such a strong starting point. When you buy one of these funds, you're not trying to guess which single company will dominate the future. You are buying a wide slice of the market itself. You are saying, in effect, I believe businesses will keep growing over time, and I want my money tied to that long-term growth. That approach may not sound exciting, but that is exactly why it works. The more boring your investing strategy is, the easier it becomes to stay consistent when emotions start pulling at you. And emotions will pull at you. They always do. There will be times when the market feels unstoppable and people around you start acting like investing is easy money. There will also be times when everything looks terrible and it feels like the whole system is falling apart. In both environments, beginners are vulnerable to making the same mistake from opposite directions. When markets go up, they get greedy. When markets go down, they get scared. In both cases, they abandon the plan. That is why your real goal as a beginner is not just to invest. It is to create a strategy that protects you from yourself. A strategy that still makes sense when you are excited, when you are nervous, and when you are bored. Because one of the least discussed truths about investing is that boredom is actually a feature, not a flaw. If your portfolio constantly demands your attention, something is probably wrong. Good investing should feel almost uneventful most of the time. Quiet, repetitive, predictable. The drama usually comes from people, not from the strategy itself. So what should a beginner actually buy? In most cases, one broad U.S. stock market index fund, one S&P 500 fund, or a total market fund is enough to get started. Some people will also add an international fund for broader global exposure. Others may eventually include bonds, depending on their age, goals, and tolerance for volatility. But the key point here is that a beginner does not need 10 different funds to be diversified. More options do not always mean a better portfolio. Sometimes they just create confusion. This is important because beginners often assume diversification means owning a little bit of everything they've ever heard of. A few tech stocks, a dividend stock, some crypto, maybe a real estate fund, a couple of random companies they recognize, and a fund or two they pick because the name sounded smart. It feels diversified because there are multiple positions, but often it is just scattered. Real diversification is not random collecting. It is deliberate spreading of risk across many holdings through a simple structure. Once you choose your investments, the next step is deciding how much to invest and how often. And this is another area where beginners overcomplicate things. They think the amount has to be impressive to matter. It doesn't. What matters most in the beginning is consistency. A person who invests a modest amount every single month will usually beat the person who waits around for the perfect time to invest a larger amount. This is because investing success is less about intensity and more about repeatability. If you can invest $50 a month, start there. If you can invest $200, great. If you can do more, even better. But the important part is to make it automatic. Automation is one of the most underrated tools in wealth building because it reduces friction and removes emotion. When you automate your investments, you stop relying on motivation. You stop negotiating with yourself every month. The money moves whether you feel inspired or not. And that matters because financial progress is usually built on systems, not moods. This is also where dollar-cost averaging becomes useful. That phrase sounds technical, but the idea is simple. It means investing at regular intervals instead of trying to guess the perfect entry point. Sometimes you'll buy when prices are high. Sometimes you'll buy when prices are low. Over time, this smooths out your purchase price and prevents you from getting paralyzed by market timing. For beginners, this is powerful because trying to wait for the perfect moment usually becomes an excuse for doing nothing. The market dips and you wait for it to dip more. The market rises and you wait for it to come back down. Meanwhile, months pass and your money stays on the sidelines. That is one of the biggest mental shifts beginners need to make. The question is not, is this the perfect time to invest? The better question is, when does money need to start working for me? And for most people, the answer is as soon as they are financially stable enough to begin. Time in the market matters more than timing the market. It sounds simple because it is simple, but simple does not mean easy. It is emotionally difficult to invest when headlines are negative. It is emotionally difficult to keep investing when your account balance drops. But that discomfort is normal. In fact, it is part of the price of admission. If you want the long-term returns that markets have historically offered, you have to accept the short-term uncertainty that comes with them. There is no version of investing where you get growth without volatility. That trade-off is not a flaw in the system. It is the system. And beginners who understand this early have a huge advantage because they stop treating market drops like evidence that something is wrong. They begin to see them as part of the environment. This is where risk tolerance comes in, and beginners often misunderstand it. They think risk tolerance is about how brave they are. It is not. Risk tolerance is about how much volatility you can handle without making destructive decisions. You might think you are comfortable with risk when the market is going up, but your real tolerance shows up when your investments drop by 20% and you feel sick checking your account. That is why you should build a portfolio you can live with, not one that just looks aggressive on paper. A good beginner portfolio is one that lets you sleep at night and stay invested through difficult periods. Because staying invested is the whole game. If your strategy is so stressful that you abandon it during the first serious downturn, then it was never the right strategy for you in the first place. The best portfolio is not the one with the highest possible return in theory. It is the one you can actually stick with in real life. Now let's talk about one of the most damaging habits beginners fall into, and that is checking their investments too often. On the surface, this seems harmless. You invest some money, you're excited, and you want to see what it's doing. But over time, constant checking creates emotional noise. Every tiny drop feels significant. Every green day feels like validation. You start reacting to movements that are meaningless in the long run. And the more often you look, the more tempted you are to interfere. This is one of those strange areas where paying less attention often leads to better results. Not because you should be careless, but because long-term investing does not reward constant emotional engagement. It rewards patience. If your goal is decades of growth, daily fluctuations should not have the power to change your entire plan. Markets move constantly. Your strategy shouldn't. That brings us to another beginner question. Should you pay off debt or invest first? The answer depends on the type of debt. If you have high-interest credit card debt, that usually needs to be your priority. A guaranteed loss of 20% interest is far more urgent than chasing uncertain market returns. But if you have lower interest debt and a stable financial base, then investing while paying that debt down can make sense. The point is not to be dogmatic. The point is to understand the order of operations. Wealth building works best when your decisions support each other instead of competing with each other. And that is really what investing for beginners should feel like. Not chaotic, not flashy, not overwhelming, but orderly. First, stability. Then the right account. Then simple, diversified investments. Then automation. Then patience. That is how ordinary people build extraordinary results over time. Not by making one brilliant move, but by putting a few timeless principles in the right order and repeating them long enough for compounding to do what it does best. Here is what most people miss when they first start investing. The returns matter, of course, but the bigger transformation is behavioral. Once you begin investing consistently, even in small amounts, your relationship with money starts to change. You stop seeing every dollar only as something to spend. You begin to see it as a worker, a builder, a seed. You become more aware of trade-offs. You think longer term. You start asking better questions. Not just, can I afford this, but what is this costing my future? That mental shift is where real wealth building begins, and it often happens long before the numbers look impressive. That is why beginners who start early often end up far ahead of people who earn more but never build the habit. A higher income helps, of course, but income without systems has a way of disappearing. One person makes a decent salary, spends most of it, and tells themselves they'll invest later when life feels less expensive. Another person starts with small automatic contributions, keeps it simple, and stays consistent for years. From the outside, the second person may not look impressive in the beginning, but underneath the surface, something powerful is happening. They are building momentum. And momentum in investing is one of the most underrated forces in personal finance. This is where compound growth starts to become more than just a phrase people throw around. At first, compounding feels slow, almost insultingly slow. You invest a little, the market moves around, and the gain seems small. It can feel like nothing important is happening. That is exactly why so many people quit too early. They expect visible progress right away, and when they do not see it, they lose interest. But compounding is not designed to impress you in the beginning. It is designed to reward patience over time. The early phase feels quiet because you're building the base. Later, when the numbers get larger, the same percentage gains begin to create real movement. That is when people suddenly call it powerful, even though it was working the whole time. The challenge is that most beginners want evidence before they commit. They want to feel certain before they start. They want reassurance that every choice is perfect. But investing does not reward perfection. It rewards action paired with discipline. You do not need to know everything to begin. You need to know enough to avoid the major mistakes and enough to keep going when things feel uncertain. That is a much lower bar than most people imagine. So let's bring this back to the step-by-step process in the clearest way possible. First, make sure your foundation is solid. Build a cash buffer. Handle high-interest debt. Create enough stability that your investments can stay untouched. Second, open the right account. If you have access to tax-advantaged retirement accounts, especially with an employer match, use them. If not, open an IRA or a brokerage account and get the container in place. Third, actually invest the money once it lands in the account. Do not let it sit there in cash by accident. Fourth, keep the investment simple. Broad, low-cost index funds are more than enough for most beginners. Fifth, automate your contributions so the process happens without constant effort. And sixth, stay invested long enough for the system to work. That last part sounds obvious, but it is where the real battle happens. Because the hardest part of investing is rarely the mechanics. The hardest part is behavior. It is staying calm when everyone else is emotional. It is continuing to invest when headlines are negative. It is resisting the urge to chase whatever just went up the fastest. It is tolerating the feeling that you could be doing more, even when doing less is exactly what your plan requires. This is why beginner investing is not just a money skill. It is a patience skill, a discipline skill, a self-control skill. The market will tempt you in both directions. Sometimes it will tempt you to get greedy. Other times it will tempt you to run. And most financial mistakes happen when people mistake emotion for insight. They feel something strongly, so they assume they should act on it. But in investing, strong feelings are often a signal to slow down, not speed up. If the market drops sharply and you suddenly want to sell everything, that does not necessarily mean selling is the smart move. It usually means fear is doing what fear does. If the market is soaring and you feel an urgent need to pile into whatever everyone is talking about, that does not necessarily mean you found a great opportunity. It often means excitement is clouding your judgment. The discipline of investing is learning that your emotions can be real without needing to be obeyed. Another thing beginners need to understand is that investing is not supposed to solve every financial problem at once. It is one part of a larger financial life. You still need healthy spending habits. You still need to grow your income. You still need to avoid lifestyle inflation, swallowing every raise. Investing works best when it sits inside a bigger system of financial discipline. It is incredibly powerful, but it cannot outinvest chronic overspending. It cannot fully compensate for a life built on unstable decisions. Wealth grows best when your habits, your income, and your investments all move in the same direction. And that should actually feel encouraging because it means you do not need some secret strategy. You do not need access to elite financial circles. You do not need to be gifted at predicting markets. What you need is a repeatable plan and the maturity to stay with it. That is far more attainable than most people realize. The reason it looks rare is not because it is complicated. It is because consistency is rare. Most people are not held back by a lack of information anymore. They are held back by overload. They know too much and understand too little. They consume endless clips, opinions, predictions, and financial hot takes until investing feels like a giant cloud of noise. One person says buy the dip. Another says wait for a crash. Someone else says only invest in dividends. Another says growth stocks are the future. Then crypto enters the conversation, then real estate, then gold, then recession fears, then rate cuts, then inflation, then politics, and suddenly the beginner who just wanted to start investing feels mentally exhausted before they even begin. That is exactly why simplicity is such an advantage. Simplicity cuts through noise. It gives you a standard to return to when everyone around you is overreacting. It reminds you that your job is not to win every conversation about money. Your job is to build wealth gradually and intelligently. If a simple, low-cost, automated strategy feels almost too plain, that is probably a sign you're closer to what works than what entertains. There's also something deeper that happens once you start investing consistently. You begin to trust yourself in a new way. Not because you suddenly become fearless, but because you prove that you can act in your own long-term interest. That matters more than it sounds. Every contribution becomes evidence that you're no longer just reacting to life financially. You're building something. You're planning. You are participating in your future rather than hoping it works out on its own. And that changes how you think. You become less vulnerable to the fantasy that one big break will save you. You stop expecting a dramatic turnaround from one lucky decision. Instead, you start respecting steady progress. You begin to understand that wealth, for most people, is not built in one explosive moment. It is built quietly, month by month, contribution by contribution, decision by decision. That may not be the most glamorous message, but it is one of the most freeing. Because once you accept that investing is supposed to be steady, not thrilling, a lot of anxiety disappears. You stop feeling behind because you're not trying to catch up overnight. You stop comparing your beginning to someone else's middle. You stop assuming that because you cannot invest huge amounts right now, it is pointless to start. Small amounts are not pointless. They are proof of process, and process is what eventually creates results. So if you're a beginner, here is the most important thing to remember. You do not need the perfect portfolio. You do not need perfect timing. You do not need to wait until you feel fully confident. What you need is a foundation, a simple plan, and the willingness to start before everything feels certain. Because certainty rarely comes first. Action does. Clarity usually grows after you begin, not before. Investing for beginners is not about becoming a market expert. It is about becoming the kind of person who consistently puts money into assets that can grow over time, and then has the discipline to leave that system alone long enough to work. That is the real step-by-step process. Build stability. Open the account. Buy simple investments. Automate the habit. Ignore the noise. Stay patient. Repeat. If you can do that, you will already be ahead of most people, not because you found a shortcut, but because you finally stopped waiting. And in the long run, that decision to begin, even imperfectly, is often the moment everything changes.